We figure if we get another one or two of these big banks to actually take out the 2022 lows, it's going to start to get noticed. And instead of all the focus being on one, regional banks, or two, a mismanaged bank, good excuse for the Fed, And then suddenly the public's going to say, uh-oh, this is getting out of hand.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special from May 9th through 16th, 2023, while supplies last. This week, we are excited to feature the 2023 Australian Silver Kangaroo at just $4.85 over spot. The 2023 Silver Kangaroo from Australia are renowned for their 4/9 fine purity, as well as their recognizability and design. Like many other coins, they come 25 to a tube. However, unlike others, the Australian Monster Box is just 250 coins, making it the most affordable Monster Box available, especially with a premium of just $4.85 over spot per ounce. And finally, Silver Kangaroos are IRA eligible. If you'd like to learn more about a precious metals IRA, an IRA holding assets in a private depository rather than a bank or brokerage, call us, and we'll be happy to help you in that process. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Michael Oliver, the founder of Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Hi, Elijah. Good morning.
Well, good morning to you as well. It's great to have you today, and we love having you on. Our viewers very much appreciate having you on because you bring a unique perspective to the table of focusing on momentum rather than just the price of metals. I did want to quote from your recent report here on gold and silver, and you mentioned how based on momentum analysis, it looks like silver really won't turn back until it goes all the way to $34. Can you expand on your outlook for silver here?
We turned positive in phases as it turned up out of that summer low last year, September low last year. Silver sort of led the way, actually. Silver made its low about a month before gold did. And the percent gain from the low, silver gained more than gold. Even though silver's not back to its highs like gold is. In fact, gold's nipped a new high, by the way, recently, new intraday high. Silver still had a bigger percent gain. Now, when we just look, our expectations are more or less off the page. As I've explained before, gold has had 3 bull markets in the past 45, 50 years that have gone up 6-fold to 8-fold. 2 of them are 8-fold, one of them was 6.5-fold. Measured from the bear low that preceded the bull to the bull peak. Okay, so it's done 3 times. And we now have a global and certainly a U.S. economic environment in which a bubble is breaking, especially in the U.S. Our stock market had the biggest bubble in its history. And when it breaks and unwinds after a dozen years of free money and the errors that have been based on free money, family errors, business errors, state spending, government, etc., those errors are going to come to the surface in real terms. Forget stock market, okay? It's going to hurt people. It's going to be one of the most dangerous events we've ever seen, and also one of the most profitable if you're on the right side. The central banks will have to respond to this. They can talk all they want to about, quote, fighting inflation, which I cheer them. They have. They busted the inflated stock market bubble, okay? They broke it good, and it's going to go lower. And I think all we've seen for the last 9, 10 months is floundering by like the U.S. stock market in the lower half or lower third of the price zone from the 2021-22 peaks to the 2022 lows. We've been floundering with repeated rallies. Okay, now, once that rolls over, the metals knew this was going to happen. That's why they didn't break down in 2022. Gold was unchanged. Silver had a 2-3% up year, while everything else was in the tank, double digit. Now we've broken out further. Silver's gone up to 26. It's now traded in the mid 25s. Gold went back up to its highs. And then we asked ourselves the question, okay, now if gold hit another 8-fold, it'd go to $8,000. Why? Because its previous bear low was just under 1,050 in late 2015. Okay, but you're not going to do that overnight. You might do it pretty quickly. more so than the prior bull markets. But I doubt you're going to do it in 3 months. Same with silver. We think silver is going to now outpace gold, and that's the place to be. But what about where might the first pause point be? Given the positives that have already occurred so especially since early April, we had our final breakout on silver. And at that point, you say, okay, now you've broken through major momentum hurdles, including some price chart hurdles that we've defined. And since then, you got overbought in doing that. And silver and gold have gone into this sort of flip-floppy mode, but they've not given up their turf. You can just basically draw a line sideways for the last 6 weeks or so, or 7 weeks, where they've gone up and down but held their ground. Okay. Now, once they engage again, where are they going to go on that first leg, possibly? And that's what we tried to measure via certain momentum metrics. We come up with 2 swing objectives. One for gold is about 2,400. And of course, we're trading, above 2,000 right now. So you're talking pretty good percent. But on silver, which is trading 25, 26, we think it could go to 34, which is a much bigger percent gain than gold would have. And at those points, we see certain reasons to think that if you get a next surge, where would the pause occur? Where that particular surge might take a rest. So we're not arguing that that's the peak or anything of that sort. It's just a sort of a, quote, trading swing objective. And we still hold by it. And it's just a point where we think, if you're long, particularly if you're long those markets via instruments that have time attached to them, like options, you might want to pay attention at that point about, hey, it might pause here. And obviously, if it does, it could hurt your options. Time is a factor. So that's the reason we focused on that. So yeah, that's the number we came up with, but it's not really anything to sink your teeth into as far as long term.
It sounds like the long term is even better than that.
Well, the old silver gold ratio is, silver's at one time was 6.5% of the price of gold. That's back in the mid 70s, I think it was, or 1980. And then there have been repeated times over the last 40, 50 years where if you plot a spread chart, the monthly close of silver, the monthly close of gold, what percent is the price of silver expressed as a percent of gold? So many times it's been at 2.5% to 3%. It's almost normal. Okay, so let's just take that zone of upper readings that have occurred, half a dozen times in the last 40, 50 years, where silver gets up to 2.5% to 3% of gold. Right now, silver is 1.3% of gold. Okay, so silver ratio to gold could double and get to a sort of normal spread ratio that it's seen plenty of times before, and it certainly has an excuse this time around to do it again. Okay, well, let's say gold did another normal eightfold bull market and got to 8,000. Well, 2.5% times that or 3% times that's incredible. A couple $100 silver. So on a percentage gain basis, even though going from, let's say, 1.3% to, let's say, 2.5% doesn't seem like much, it's huge in terms of silver's potential to outperform gold. So that's why we're more focused on silver than gold.
Now, as for gold, though, what are some of your price points there and outlook in the rest of the quarter here?
Well, again, that we came up with a number that was actually it's 23.95. Okay, all it is when you go back and look at a certain oscillator high reading on momentum now, not price, that we made in that very dramatic surge in April, May, June, July of 2020. Gold got X% above a certain long-term moving average that we're monitoring. Okay. Forget the average, it's the distance above it. How high did we get in that explosive surge? Well, if we simply replicated that and went back to that high and had problems there, in other words, where momentum said, okay, I'm back to an old high, I think I'll pause. Well, if you do the math and you go out, a couple months and assume it might happen then, you come up with 23.95. Okay, which is well above all the price highs we've seen since 2020. By the way, that intraday price highs have been 2070, and recently 2080. Okay. We've already made new high monthly closes for gold, new high weekly closes, and new high daily closes. We just haven't exploded well beyond that level yet. I think that's probably coming. And I think in order to help determine that, one thing investors should look at is out the side mirrors, not the front windshield. Yeah, you can look at gold and silver all you want and measure them and day by day and get fretful or get happy or whatever you want. But look at some of these big asset categories that will definitely influence the underlying reality and hence the Fed. Gold, I think, knows what the central bank is ultimately going to end up doing. And that's going back to print. Why? Because it's going to have to. It's going to have a disaster like it's never seen. And by the way, we said this a year and a half ago when we called the top in the S&P and the NASDAQ. It was February of 2022 for S&P, January 2022 for NASDAQ 100. We argued the first leg would be an arm wrestling match. It was, a lot of zigzags. We're still in that first leg. The second leg we think will be more serious. And that's when disappointment among the still excited investors out there who think, oh boy, we've got a bottom here. We've got to buy this, because Apple went up good, or Microsoft went up good. Of course, they're weighted so heavily that, they could go up good and 90% of the market go down and the market would still go up because on the index, they're weighted at double digits. But anyway, so we're focused on certain aspects of the stock market that once we see them start to roll over again, we think the market will go. We're watching Apple and Microsoft because they're two of the stellar, extremely heavily weighted symbols in the S&P 500 and in the NASDAQ 100. So as they go, so will the market, and so will sentiment, because they've been the hope-filled symbols. The other sector that we nailed was back in late January with the banks. We put out a couple reports and warned that even though banks had been behaving much better than the S&P 500 ever since mid-2022, banks made their low in June 2022, just like S&P, and had a rally. But S&P and NASDAQ went down and took out that low in October. Banks did not. So banks held better on the downside. And then when we turned up for the rally late into the year and into January this year, I think it actually extended into February, that rally was stronger than the S&Ps as well. So if you were a, quote, portfolio manager looking for the best places to be, you would have favored banks. And that was true up to that point. But our work on momentum said that, no, watch out, something's going to happen here. We're going to get ambushed in this good sector. And if it goes, watch out, because it's too critical. And sure enough, it went. And, it got triggered all over numbers in early March. And by late March, it had gone through the June lows of last year, meaning taking out the lows of the last, actually, almost 2 years worth of lows came out. But the prominent June lows of the banking sector came out. And this wasn't true just with the regional banks. It was true with the large banks like KBE, which is an ETF for the entire bank sector. KRE is an ETF for the regionals. They both took out the June 2022 lows. So it wasn't just one or two isolated banks. Our focus now is on the 6 too big to fail banks. And we put out a report the other day on them because, if they ever start to have trouble, don't worry, they're not going out of business because, they got a blank check. Okay. The issue is, though, if they start to behave in a way that smacks the average investor in the face and the Fed in the face, that is a factor that would definitely apply brakes for the Fed. And already has, really, because their balance sheet has started to explode again. So we've noticed that among the 6 big banks, Bank of America and Wells Fargo have taken out the June 2022 lows, just like the overall banking sector and just like the regional banks. So of the 6, 2 of them have actually taken out the 2022 lows. That'd be like the S&P right now trading 3,300, let's say, instead of 4,000 area, if the market were matching them. But we're watching the other 4. It's Goldman Sachs, Morgan Stanley, JP Morgan, and Citibank. Now, Citicorp is pretty close to its 2022 lows. It's got, in fact, you can go back to 2020 and find lows in the Citicorp where you can draw a line sideways. So punch it up on your screen, Citicorp C, okay? And you'll see what I'm talking about, how it's sort of laying on the mat. It hasn't made the new lows yet, but we figure if we get another 1 or 2 of these big banks to actually take out the 2022 lows, it's going to start to get noticed. And instead of all the focus being on one, regional banks, or two, a mismanaged bank. Good excuse for the Fed, Then suddenly the public's going to say, uh-oh, this is getting out of hand. So that's why we're watching the banks. And so we have to watch 6 symbols for the biggies. And frankly, they're starting to look vulnerable in terms of starting another rollover that might take out the June low. And so we're monitoring that, closely, and we update our subscribers on that. Because we think when that happens, I don't care what else is happening out there, forget it. This will be the dominant factor. And I think gold will respond accordingly.
Now, what does that mean, I guess, for the financial system if we see these too big to fail banks having issues? Obviously, they're not going to fail. The government's going to backstop them. But what does it mean for the broader financial system here?
We're watching the ETF called XLF, which is the broad financial sector as well. It did not take out the June 2022 lows or the October 2022 lows. So unlike the banks, the financial sector broadly defined. Now, it includes banks, but it includes things like American Express, insurance companies, quite a few financial related companies that aren't in the banking business. Okay, so it's a nice mixed weighting, and it has distinctly not taken out the June lows like the banking sector has. And we're watching it now. It's very close. XLF, for example, in the recent dropped to 30.39. It had been up to the upper 30s, by the way. Its lows back in 2022 in June and October were also either side of 30. There's one dip slightly below 30 and a bunch of other lows just above 30. Well, we stopped just above 30 again. So somebody looking at a price chart said, hey, I think I'll buy it there again. Okay, well, you got to bounce up over 33. Right now, you're back trading either side of 32. You drop another point or two in XLF, and we argue that there's enough technicals that we see on momentum that argue you're finally going to take out that obvious price chart low, meaning blow out $30 on XLF. And when you start breaking the entire financial sector, remember, it's in distinct contrast to, for example, let's say the semiconductors, okay, which everybody's cheering. Well, heck, they had a 50% collapse last year, semiconductors. So they deserve to have a nice big rally, right? Okay, it's a meaningless but a big rally. But everybody's looking at it, and they're not looking at the banks and the financials, which are basically laying on the mat. If the S&P were doing what the financial sector is doing right now, we'd be trading right now about 3,600, but 100 points off its June low. So we're watching the financial sector. It's a good point to bring up. Yeah, the broad financial sector, because if the contagion moves into that sector, all bets are off.
We had viewers submit some questions, and Karen wants to know, how is this deflationary credit crisis going to affect gold stocks short-term and medium-term? Well,
deflation in certain sense of the word, we define inflation differently than most people do. We go with the Austrian school. It's expansion in the money supply. Now, that's been ongoing for decades and decades, since I was a child, okay, back in the 50s. Okay, a loaf of bread used to cost 20 cents, and now go to the grocery store and tell me what it costs and explain to me, is there a wheat shortage? No, of course, it's a degradation in the money unit. Basically, every decade for the last 6 or so, the money M2 growth has doubled almost every decade. Actually, not double, but about 90 some odd % growth in the amount of money out there. Meaning the value of that money, this real underlying asset value, is depreciating continually. So, in any given 10-year period, if you bought a stock at $10 and it's now up at, gone up ninefold, doubled, then, you've only, that's the money supply doubles basically every decade. So you really aren't making money. It's only the nominal price of your asset. And the real inflation breakage, the deflation, if you want to call it that has now begun and will continue, is in the paper asset category. That would include like municipal bonds, corporate bonds, stock market, which took a massive hit last year, an initial first wave hit. We think that bubble is unwinding. And when it unwinds, it will be deflationary in that sense of the word. But at the same time, if the central banks respond as they always do, and believe me, they will not do this. They will increase the money supply. They will buy assets blindly just like they did in March of 2020, March of 2020 during the COVID crisis. They were buying ETFs like crazy. This is a much bigger event than that. Then that money's going to go somewhere. Meaning the money supply may not be deflating, even though paper assets are. So you can call it deflation if you want. And, in fact, it has certain justifications. But remember back in the late 70s, we had a global what we called stagflation. They invented the word for it because the economists had never conceived of such a thing, where you could have economic weakness, paper assets declining, and yet commodities exploding. And we certainly have the conditions for that. Gold, why is gold back at its highs? Okay, ask yourself that question. Since the Fed's been underway for a year and a half now, raising rates, and yet gold has gone up. They say they're fighting inflation, yet the greatest inflation metric in the world for thousands of years is at its all-time highs, especially in other currencies, but even in the dollar now, okay? So it tells you something right there about what I'm talking about. Don't confuse the term deflation with everything going down. That money flow will go somewhere. And we strongly suspect, as was the case in the late 70s, and it has been the case several other times, asset managers and investors are finally tired of a certain category. They perceive it to be risky. They've been long, too long. They think it's various ratios that they measure, economic data points and so forth. It's just too highly priced. They go somewhere else. And so they divert the river flow that the Fed creates, ECB creates, BOJ creates, to some other place. And in the late 70s, it was the commodities, but especially gold and silver. So they went up while the market was a wasteland. I was a futures broker back then. And I remember in the office, the phones of stockbrokers would never ring. In fact, there were about 2 brokers would be in the office where 10 were out to lunch all day. Okay, some of them wouldn't come in. So little business during that wasteland, and yet my phone was ringing like crazy. Anyway, so that's an example of what I mean. Yes, you could have, quote, a deflationary event in certain categories, but don't assume it's going to hit all categories the same way, particularly when you look at the historic price levels. Forget gold for the minute. Look at commodities. The Bloomberg Commodity Index right now is trading about 103. It got down to the high 50s in late 2020. This is when gold had already made its high and doubled in price. Commodities have continued down from 2016, 17, 18, 19 to late 20. And they all exploded in chorus. In October of 2020, we put out a report that said commodity explosion underway, quote unquote. It went from our breakout level at 70 in October of 2020 to an early 22 high of 140. So it doubled. And you think, oh my gosh, commodities, they've exploded. Well, yeah, relative to where they were, which was off the page at theoretical zero prices. And since then, they've taken, since February, March peaks in 2022, right after the war began, by the way, commodities peaked. That didn't cause them to go up. They went up before the war. But after then, they corrected pretty much in unison, oil, grains, etc., and pull back to around 100. So you've had the high monthly close was 131, so we pull back to around 100. So you can do the math. It's like a 20-some-odd% correction. It's taken a year and a half. While the stock market's been rallying for the last 10 months, commodities have been oozing gently down, correcting. We see evidence that they're trying to turn up again and start a second up leg in commodities. Well, let's look at where we've been before. If we're at 103 Bloomberg Commodity Index right now, which is a good broad index, you go back and look at 2008. Again, commodities and gold were vastly outperforming gold then. I mean, the stock market. The Bloomberg was at 237, more than double where it is now. It dropped, and in 2011, it came back up when gold made its all-time high. Commodities bounced with it to a lesser high. At that point, they were in the 170s, Bloomberg. Right now, we're 103. So by no measure can you look back and say, oh, we're the highest level in 40 years. Only if you measure percent change year over year, but you're measuring from vastly low price levels in the Bloomberg and in commodities in general that we increased from in 2021 and 2022 versus 2020. that yes, it was a huge percent increase compared to other years' increases, but on an actual price basis, we're still less than half the price that commodities were into a decade or so ago. Okay, so that argument is wrong. So commodities have room to go up and still only get back to where they were in 2008 and 2011. Plenty of price room to go up just to match those highs. So put that in context too when you think about if deflation hits, where is the vulnerability going to be? We don't think it's going to be commodities. We think commodities and gold will go up and bloated paper assets will go down.
Now, David is wanting to know what would make you change your forecast for precious metals at the moment. He says, last interview, Michael Oliver stated his models were all green lights for gold. What would need to occur for those green lights to turn off or reverse? What might he advise if that reversal is to occur?
Okay, we have a methodological problem at MSA. We use our own methodology we developed back in the 70s and 80s. I caught the crash in 87. I didn't catch it big time, but I caught it. And I did it via momentum methods. And I then applied it, and we started a research firm in 92, okay, using these methods, which we've hardly embellished over the last 30 years. We've just used them because they've worked. One of our rules is in order to change a trend, we have to see momentum trend structure. Forget the price chart. We have to see structure on momentum that looks vulnerable. For example, if you're looking for a downside break in a market, you need to see either one, a momentum uptrend that is very well defined, which where the momentum readings have banged on a line, an ascending line of support for a good period of time, several years at least, before you think in terms of a long-term trend shift the other way. If that gets broken, then you pay attention to the potentials to go down in that market. Or if you've got a flat floor, where a market has repeatedly come to the same momentum level as support and finally breaks it, just like if it were a price chart. In fact, this is what happened in 1987 in October. We had a flat floor that went back, it was an uptrend, went back 7 years, and a floor that went sideways for 3 years on momentum. They both converged such that in early October of 1987, we broke it. 2 weeks later, the crash occurred. Okay. When we look at the S&P and the NASDAQ 100 right now, we see no such structure to break on the upside. All the structures that we had were broken in layers. Since January, February of last year, they broke a very clear ceiling level that had restrained them for all during the bull market. You got to certain levels on the momentum charts of these indexes and couldn't get through it. Finally, in that blow off that occurred after the COVID crisis, where the Fed printed a lot of money quickly, the indexes went vertical and they went through that ceiling. So it's like an elevator going through the top of a building. Okay. As soon as it aborted back down through that ceiling and said, oops, my breakout is failing, we put out a sell signal. And that was at those times, January 2022 for NASDAQ, February 2022 for S&P. What then happened was both of them dropped down to a floor that goes back on annual momentum, 12 years, where they had repeatedly been dropping down to a specific level on the momentum charts. You couldn't see it on a price chart, but you could on momentum. It was a floor. If you saw the momentum charts, you'd be bearish, okay? And they broke them. The rally since then has been nothing but wheel spinning, mostly around that floor that they broke. So it's just like, if you saw a price chart and look at our momentum charts and treated them as a price chart, you would say, gee, this thing just broke a massive floor and it's rallying and bumping its head on the underside of the floor. There's nothing above us technically for MSA to say, oh, stock market's turning up, and the same principles can be applied to gold. We just had our flush out in gold. If you wanted to get a clean out on the downside in gold and run everybody out of the market who was afraid, you did it. And that occurred back in summer of last year. And this is how it occurred even on a price chart. Gold had made repeated lows at 1675 area after it had its surge in 2020. It went down to 1675, went back up, even went back up to its highs again, 2070 in March of 2022. Came back down to 1675 again in the spring of 2022. And finally in the summer, it broke that level to where anybody with a crayon and a ruler could say, oh my gosh, gold broke a floor, the price floor. It did. It dropped all of 3% more, actually 3.5%, if you call that a follow through, and went to 1613. Spun its wheels for about 6 weeks, barely below the point it broke, and aborted back up into its prior range and said, I fooled you. And we predefined that downside breakout as a bear trap because our momentum indicator said, nope, this is not sustainable. And sure enough, it wasn't. Now, since then, we've broken out over ceilings on momentum, and even price has done similar things that point to the upside. So no, we don't have the metrics where we could give you a number that says, oh my gosh, we're wrong, gold's going to fail, stocks are going to turn back up. There are no momentum structures that look valid in that regard. So methodologically, we can't answer that question, and I don't think we're going to have to.
All right, well, it should be very exciting weeks and months ahead here, Michael. Before we let you go, where can our viewers find you and sign up for your newsletter if they're interested in learning more?
It's Oliver MSA from MomentumStructuralAnalysis.com. Explore the site and find out about our methods, some of our historical charts and reports and so forth. And you can request a sample copies. And thank you.
Thank you so much, Michael, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.